And we should be going live here, Amar.
All right.
Let's see. Yep, there we go. I think we're going live. Hold on just a second. I think we heard Mr. Asterisk say he's ready to spend our money, Amar. That's right. So we got to invest well to get the asterisk to spend our money. All right, cool. I've already got advertisements. All right, sweet. So we're going to start making money off this because I see advertisements on there. So I think the YouTube is about a couple minutes behind us. Not a minute, but a few moments behind us. All right. Maybe I'll take notes instead of chatting. All right, is he coming on? Looks like we are on. Hold on. Oh, World Economic Forum is advertising on my channel. You've got to be kidding me. There we go. All right, so we're on here. All right, cool. All right, sweet. Welcome, everybody. So we got my man Amar here. We got Amar Shaw from Client First Cap in San Diego. Rosemary says she has us up on the big screen. Hope we don't have boogers hanging on my nose because that would be disgusting. All right, so this is the first episode of our 13-week masterclass. All right. And we're going to talk about 13 distinct wealth management topics and issues, not just for rich people. A lot of these things everybody needs to focus on for sure. And Amar and I, we were both at USA. I'm not going to go through the whole introduction about Amar again because we've done that 1,000 times on this channel. But just remember to sign up to subscribe to Amar's channel if you would. Actually, let me see if I can. Can you put comments in here, Amar?
It doesn't allow me to. I tried earlier.
So what's your YouTube channel again? Client First Cap?
Yeah, it's Client First Capital Learning. So it's our learning channel.
Okay, gotcha. On YouTube. Subscribe to Amar so he can make some of that sweet YouTube money as well. All right, gotcha. So what we're going to talk about here today is going to be investments. What we're going to talk about here today, and we're going to go over the 13 different ones in terms of the topics we'll cover shortly. But first and foremost, I want to share with you guys the landing page. Let me just close my door so my zombie dogs don't come in here. Hold on just a second. So I want to show the landing page. If you all want to download this Chrome window. Building is this? Yeah, right here. I'm gonna copy. Can you all? All right, hold on. Amar, do you see the landing page?
I do see the landing page.
So here you can download built on evidence-based financial advice and sound investment strategies. You can sign up for the bi-weekly emails if you want. Download the free PDF guide. Can you just click on that to download? Oh, sweet.
Yeah.
So you don't have to put your email in there if you don't want, right?
Nope. You don't have to put your email in there. You can just click that to download. We're going to walk through these 5 now so you can have that handy.
Okay. Oh, yeah. So everybody, let me go ahead and put this in the comment section then. So I'm going to put this in the comment section. Hey, what's up, Peter? All right, cool. So you can download that right now, and we're going to walk through these 5 strategies that we're going to talk about here right now real quick. So that'd be good. We're holding just a second. Okay, that looks good. It looks good. It looks like everybody's good. All right, so let me get out of that, Amar, and hold on just a second. How do I stop screen right there? Okay, good. We're back. All right, so
do you have the 13 wealth management concerns so we can just kind of give a brief overview of like the next 13 episodes of what we're doing?
I don't have. Do you have it available real quick? That's good.
I can pull it up. Hold on.
All right, so anyway, while Amar's pulling that up, there's this thing called Canon. I can't remember what it is, Canon Financial or something like that. And they have this actually fantastic training that we both took at USAA. I think a lot of firms are using that to some regard now, but I was a big fan of it. I thought it was some of the best financial planning training that there ever was. And this is, it was more realistic than the CFP. Let's just put it that way. It's not perfect. No financial planning is perfect, but it was good. And we're going to bring that to you guys, kind of using the stuff that we learned from Canon. What is it called? Canon Financial? I can't remember what it's called, the Mars. Canon Financial?
Canon Financial.
I think at Athens, Georgia, if memory serves.
Yeah, they're based out of Georgia. So I have it on my screen, but I don't know. Will it let me share?
Try.
Okay, let's see. Going back in here, and I'm going to say share screen.
Dude, that worked. That'd be sweet. Sniffy, 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 Joe. All right, there we go. Now I got to click on it. Now I'm going to click on add as stream. What do you see tomorrow?
Well, I see the 13 wealth management concerns. So again, Josh and I are going to walk through all 13, and we're going to use every other week. We're going to do one.
Make that bigger. Amar is small.
Yeah. Oops. Does that look like it's getting bigger on your screen?
Oh, yeah, right there. Perfect. Yep, perfect.
So, the first one is investments, which we're going to cover today. And then we're going to go over qualified retirement plans 2 weeks from now, 9:30 Pacific and 12:30 Eastern. So we're going to try to do this every other week on a regular cadence till we get through all 13. But stock options, insurance liabilities, titling of assets, going through the right legal documents to have, estate planning and charitable giving, and if you're a business owner, some of the business owner type issues. So you don't have to attend all of them, but if there's one that piques your curiosity, we definitely encourage you to attend.
Yeah, if nothing else, just come on board and just get us the algorithm boost by your attendance for sure. But today we're going to talk about investments. That's first and foremost on a lot of people's minds for sure. So you want me to bring up that 5, or you want to bring it up, or what do you got it there?
Do you want to bring it up? And then
that's fine. What we're going to do, everybody, is we're going to share my screen, and we're going to build right here. All right. And then we're going to click on this guy right here. And I think I might need to share my screen on that too. Hold on just a second. Hey, babe.
Can we grab puppies?
Well, let me just stop. What's that? Yeah, you are. You're on. There you are. There she is. I told you I was married. Hey, look, just look. Hey. Josh and I've been married. Oh boy, I'm gonna get killed for that. She's like, I'm not on. All right, here we go. The top 5 considerations. There we go. Can you see that, Amar?
Yeah. Okay. You can make it bigger too, right?
Yep.
And it doesn't look like it's full screen on this side, but
it should be. What's it? There we go. There we go. Sweet.
So this is the brochure that we're going to go through, or pamphlet, whatever you want to call it. If you go through investments, human behavior is a big hindrance in investing. So we're going to go through the top 5 things that we could focus on and make sure that your investments are getting ahead in retirement or any stage of life that you're in. And so the first thing is to know your risk tolerance, right? And I think this is a big one.
Yeah.
And risk tolerance is a measure of volatility. So when we look at this, I think there's 2 ways to determine what your risk tolerance could be. One is that you can find out based off how much risk you can tolerate. When do you feel like you have to make changes with your investments? What is that downside risk exposure? So one is, how connected are you to your investments emotionally? And most of the risk tolerance questionnaires that are out there in our industry is basically doing that. Is how much, do you want to be a conservative, moderately conservative, moderately aggressive, or aggressive? And then the other way to go about it is based off your financial circumstances. And here you need to identify how much stable income that you need. What is your downside risk tolerance? Your time horizon.
Mm-hmm.
Maybe you have some investment constraints. Maybe you have a concentrated position in like company stock that you can't sell. Then how do you invest your other assets to reflect that? Also, your liquidity needs and some tax sensitivity around that. And I think what you'll find is that you'll get like a field goal post, right? So you'll get, this is where I'm comfortable taking risk, and this is where my plan says I need to take risk. Well, if your comfort level is higher than your plan, then you really need to identify why you're taking more risk than you need. And if it's the other way around, where your risk is lower than what you actually need for your goals in the future, then you need to identify if you can take on more risk, if you feel comfortable taking on more risk, or maybe decrease your expenses to get in line with that. And I think that is the key point here, is you really need to identify what risk you're comfortable with. And risk is basically a measure of volatility. In my practice, over this, I don't know, Josh, 17 years or so that I've been an advisor, I realized that most people don't really care too much about volatility. They care more about downside risk.
Exactly.
And so making sure you identify what your comfort level is on a downside risk is probably more important than the actual volatility.
No one cares about volatility if it's going up. It's only when it's going down that people actually, oh my goodness. And I'm like, yeah, well, the funny thing is, Mars, some of these software programs and risk tolerance questionnaires, they just, it's silly because they say, okay, you're a moderately conservative investor. Well, what exactly does that mean? Or you're a moderately aggressive investor, as if your tolerance for risk won't change depending on the circumstances of the day. And that's my biggest frustration as well. I filled out this thing that says I'm moderately aggressive. After March of 2009, I guarantee a bulk of people who are aggressive investors all of a sudden were not aggressive investors anymore. If that makes sense. And I myself included. Now, that was the first time I ever owned any bonds, because I said, man, it's actually kind of funny because now we got Sniffy Joe in the office with Democrats controlling the House and the Senate. It wasn't anything like it was in 2009. I mean, it wasn't anything like it was. In 2009, we were at the bottom of the barrel. And I'll never forget thinking for the first time, I said, I don't know if we're going to come out of this. And that doesn't mean we don't know what the future holds. But just because you have risk tolerance or tolerance for risk, volatility when the markets are up, the question you've got to ask yourself, what if they go down? What I always do, Amar, is I'll say, okay, we got $1 million. All right, so here's how it can shake out. Let me just unshare this for just a second. We got $1 million in our portfolio. Well, the portfolio is going to do one of three things. It's going to stay flat, where you still have $1 million. It's going to go up 20%, where you have 1.2 million, or it's going to go down 20%. If the market goes down 20% and you are now $200,000 poorer, are you okay with that? I mean, literally think about it. And the way I look at it is, let's say you have a $5,000 a month mortgage, which I don't, but just say you did. Now you do probably, Mark. You live in San Diego, and those one bedroom houses are $2 million. But if the market is down $100,000 and you get a $500,000 a month mortgage, you've just lost 20 mortgage payments. Are you okay with that? Yeah. So keep going, Mark. I'll bring whatever else you want to talk on that. Keep going. Mm-hmm.
No, I think you hit all the key points. I think and I think we're in a hard situation right now where the amount of risk that we're willing to take on
is
naturally increasing because interest rates are so low.
Yes.
So bonds historically have been your stable source of income, where right now, I mean, the 10-year is barely over 1%. And so that's causing people to take more risk than they would feel comfortable with normally, but they have to make sure they stay within those investments when there's that downside volatility. So the second point here is, how will you manage your risk? And how you will manage your risk is mainly around process. Make sure you have a defined process so that your human emotions don't get in the way of investing, right? And so make sure you have a risk management process that if this happens, these are my next steps. And if this happens, these are my next steps. So you have, for both the downside and upside, some defined steps, so you don't let your emotions, drive the car drive your investments when when you're influenced by short-term data.
Yeah, absolutely, and that's the So Kim, so give an example of that is how you, and I'm going to pick on you for a second, Kim, and not negatively, but Kim said, I missed it. All my money was in bonds. I was too scared to lose money. And that's where you got to identify your risk to begin with, because we got to say, look, at the end of the day, if I cannot take a 25% decline in actual dollars, all right, if I can't do that in actual dollars, what do I do to manage that risk? Because I can't take it. So the one thing we want to avoid at all costs is to be Josh, where I didn't have that much money in 2009. I'm not gonna lie to you. So it wasn't that big of a deal, but you don't want to be in bonds after getting killed in stocks. Now you're in bonds because you're too afraid. And then the stock market tears it up for the best performance we've probably ever had. Go ahead. Mm-hmm.
Yeah. You missed the upswing, right? So the volatility is both positive and negative. So you have to stay true to your risk tolerance over the long run. And adjustments that you make to your risk tolerance should really be based off of your life stages, right? Like, you don't want to feel that downturn anymore, and investments are at a place where you can make that change. The process is good because you need to have a defined approach to how you're going to manage your money.
I'm trying to get your thing so I can put people to subscribe to your channel here, Amar. Hold on just a second here. There we go. No, you keep talking. If you're wondering why I'm looking at over here, it's just I'm trying to get your channel up here.
Yeah. So Vinyl One Earthlink makes a good point. Is that when you haven't lost any money when you have volatility, right? You still own the same amount of shares. Now, you could choose to lose money by selling those shares, right? But if you own the same amount of shares on the way down, on the way up, those shares are going to be worth more as well, right? So it is important to kind of maybe change frame of reference to what is the quantity of companies that you own, right? What is the quantity of shares that you own? And keep that as a focus point, because over the long run, the more stuff you own, typically within equities, regardless what those equities are, they will be worth more over the long run.
I think a lot of people actually don't have a way to manage risk. I do. I think a lot of people say, I'm just going to, I'm going to go full throttle with whatever my gut tells me to do. And I just, I just think that's not a good strategy, frankly. And that could, even how you manage risk in market could even include, stop loss orders, even if
whatever it is for you is what you got to follow. Like, I have clients that do stop loss orders because that's how they manage their downside risk. I have clients that, use different trading strategies. Yeah. And that's what they use to manage risk. But not having a process is what's going to get you hurt in the long run.
Well, because then you're just chasing stuff, and the chasers in investing never win. That's just a fact. So and I just want to revisit what Kim said, because she missed out on the stocks. This was the inflated asset issue that we have to contend with. When they lower the Feds, keep interest rates low, it's not just the Feds, but when the interest rates are low, they want to inflate the assets, and they have inflated real estate, they've inflated bonds, and they've inflated stocks as well. And that's the issue here, is that is what was kind of contending with the overall investments, that can only go on so long. No one knows when it's going to stop, but how do you, not just Kim, but anybody, how do you manage the inevitable market decline? It happens all the time. And Amar, I'll never forget October. It was in August 2011. Me and this guy Rich were driving to West Point to do a seminar, and the market was down like 15, 16%. The S&P 500 from July to August, about a 45-day time frame. And I had this general text me. Did he text me or call me? I can't remember. He wanted to get out. He wanted to get out of the market because he said, "This is it." And I'm telling you. And look, it's his money. Do whatever the hell he wants. So I don't think you should. But it's your money. Do whatever you want to do. I don't care. I mean, I did care, because I say you shouldn't do that, man. I mean, my goodness. But presumably he got out of the market, and I don't know when he got back in. But the issue was he fell for the idea that the market, if you look at the charts of the S&P 500, it looks like the market goes up, 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 down, up, 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 down. But it's not true. The market goes down every single year to some significant degree. It always does. And if you just look at 2020, you'd never know that we had a 35% decline.
Yeah, we had the largest, most severe, and quickest bear market
ever.
2020. Yeah, ever. And I think maybe one of the risk management process could be to turn off the TV, turn off the CNBC channels, if you will, because what I found in this year, from an advisor's perspective, that I've had, with COVID, people being at home, having the TV on, and having access to their accounts just on their laptop, iPad, whatever, iPhone or whatever cell phone that you have, smartphone, that you can make changes based off how you feel that moment. And so maybe one risk management process could be not to look at your investments on a daily basis, maybe quarterly, maybe annually, whatever works for you.
100% agree with that. In fact, one of the things, given that, also, I think they'll give you more sanity as well. I mean, if things are making you miserable, just get rid of it, man. Get rid of it.
Yeah.
Right,
so point number 3 is
right here
around tax efficiency. So we know that for most investors, taxes and fees are the largest expenses regarding their investments that they'll have.
Yeah.
I mean, it's pretty black and white, if you will.
No,
and so one of the things is to be more tax efficient around your investments. And Josh and I did a video, I think it was like middle of December or November, around tax efficiency. But if you are on the landing page, you can go to the tax efficiency landing page. And there's another brochure that Josh and I put out that has, the 5 tips that we have around tax efficiency. But the one thing that I see,
the landing page, the one that you had sent me earlier.
This is in November.
Oh, yeah. No,
I can dig it up while you're talking. But the point is the couple things that we see, long-term capital gains versus short-term capital gains, using lot cost basis instead of average cost basis. That's a big one. If you're let's just say you're a moderate investor and you have a IRA, a Roth IRA, and a taxable account, you shouldn't be moderate in all 3. You shouldn't have the exact same investments in all 3, right? Anything else there, Josh?
I also too I want to be very crystal clear. I was working with a guy today, just a couple minutes before we jumped on here. He's got a lot of money in a post-tax account. It's great. The problem, though, is that the software doesn't and no financial software I'm aware of does this, but in the out years, so he's 50 years old today, and he's going to be spending all his taxable assets down because he has hardly anything in a pre-tax account. It's all in tax. It's awesome. But the software doesn't recognize that you can do specific identification. You can look at capital gains. You can look at capital losses. You can sell bonds before stocks. The software just does it all pro rata. And so when I was explaining to him, I said, look, man, we'll call him Tim. I said, Tim, it's not his name, but I said, Tim, make sure when you are actually engaging in the sale of securities in which to fund your retirement, that you're actually looking at this stuff. And he got it, but because the software said, oh man, you're going to have, 70,000 long-term capital gains, another 60,000 here. I said, that doesn't necessarily have to be true. It just the software doesn't know. And frankly, we don't have any idea what your capital gains are going to be 10, 15, 20 years from now. We don't. So if you have stocks, investments, ETFs, and anything like that in a taxable account, it's more than just looking at IRAs and Roth IRAs and taxable accounts, looking at what's inside those accounts too. And I think, Amar, a lot of people missed the boat there. Kind of going back to what you said, they'll have the same risk tolerance in each account, asset allocation, 60, 40, 60, 40, 60, 40. Don't do that. But also look what you actually have in your account as well. Secondly, tax efficiency of your investments. What just happened 2 weeks ago? Some of these Vanguard funds and all kinds of funds had huge capital gain distribution, gigantosaur. I think the Vanguard Capital Opportunity or Prime Cap is like 13% of NAV. And so as such, you got a huge tax hit without even doing anything. And lastly, you just got to understand this stuff, man. And I've said a million times this Sunday, don't buy the damn dividend. And I don't want to get too deep in that now because it's kind of yesterday's news, but it will come back to that before you make an investment, make sure you're not buying a dividend. It's going to hurt your taxes. The point being is tax efficiency isn't just buying an ETF, and that's not the end of the road. There's so much more than that for sure. And no one takes advantage of it. And as such, they're paying too much in taxes. It's an inefficient portfolio.
And Josh, I just thought maybe we could also do a video on the different strategies around tax loss, right? Because you have long-term capital gains, highest cost basis first to reduce your tax bill, right? That's going to do the most to reduce your tax bill. You could do short-term, lowest cost basis to have the most tax bill, right? So like there's several different strategies around that. I think that would be a good piece of content we could put out there.
Right now, or
no, in the future.
Oh, yeah, right.
In the future, yeah.
Well, I think I was spot on. And don't forget, like my man here, Lola.
All right.
Lola. Who sings that song, Amar? Lola, Lola, Lola. You know? One of the most underrated English band of all time, the Kings. Anyway, so most brokerages do FIFO, first in, first out by default. It's good at comment. Remember, just because it's FIFO doesn't mean it's bad. It depends on what the long-term situation is. This is where some tax planning comes in, and you can hear old Finney in the background. This is where tax planning comes in big time too, because sometimes it makes sense to do FIFO. Sometimes it actually makes sense to not take tax loss. I mean, there's lots of different things that's so unique to your situation. One of the things, Mark, just real quick, what's your thoughts? You know, they got these robo advisors at Betterment. Is Betterment still? Is there still
Betterment, Wealthfront?
Yeah, Wealthfront. One of those firms is no longer there. They got bought out or something like that. Anyway, they argue that they can increase your net returns by an algorithmic AI doing tax loss harvesting. I think that's overblown in a lot of degrees, and I think a lot of people. Did you concur with that? Is that what
Yeah. So, I mean, our industry has said tax loss harvesting is a way to create value for clients, right? And so I think they've taken that to the X degree of like, we're going to create so much tax loss harvesting that we're going to show more value.
Right.
But I would caution people, because what you're doing is you bought an asset, you're locking in that loss, and then you're buying a similar asset to hopefully get the rebound. But essentially what you've done is that you've taken that loss that year, but then the next time you have to sell that asset, your basis is a lot lower. So your gain is going to be a lot more. And for most people, if they're younger, their tax situation will get, they may have to pay more taxes in the future. The individuals that have like selling a house to move into a retirement home or a life event where they may be in a higher tax situation, those are the years when you want to do tax loss harvesting. You don't want to do it. I mean, everybody has a different philosophy. I believe you don't want to do it every single year because you're just delaying. You're increasing the taxes that you owe later.
And that's the pet peeve of mine is when these guys say we can increase your performance. I don't know. It's one of those. It's kind of like the Vanguard has a study on Advisor Alpha with Taxman. It's the situation is so contingent on your specific needs. But not only that, but also like Mar and I discuss this all the time. Like he has a solo 401k and he's funding that sucker something wicked. Or I think with a Roth too, right, Amar?
Yeah, so essentially you can put money into a solo 401k pre-tax or in the Roth. And some plans that have conversions built into their 401k plan, you can even put after-tax money in and then convert that into the Roth later that same week. So there are many ways to overfund a Roth type vehicle, Roth 401k, to maximize tax deferred and tax free savings.
And we're Amar and I were talking is that, we just have a different perspective here, which his is probably better. I'm just kind of lazy, but I'm deferring. I'm not doing any deferred accounts. When I mean deferred, tax deferred, i.e. taking deductions. And some people say that doesn't make sense. You're in a higher tax bracket, blah, blah, blah. Amar's not saying that. I'm just saying it's like there's no right way of doing things. There is something in your thought process that says, am I willing to pay more now? It's just so much going on with tax stuff. Just think about it. That's all we're asking. Just think about your situation, what the changes could be, understand the tax code. And lastly, for the love of the good Lord, just because you hear some guy saying, Edelman, that there's a good chance they're going to get rid of Roth. I don't know what the hell he's saying, but he apparently, and I haven't yet to hear this. I just heard a number of people say he said this, but don't do Roths because at some point the government's going to come after that money or something like that. And I've heard that a number of times. I think he probably did say that. I just find that crazy because I'm sitting there thinking the government could come after, they could do whatever the hell they want to do as witnessed by 2020. And as such, you can't plan on what the government could do. You got to plan on what they are doing and what the tax code is today. Now, you can make pretty safe assumptions that Sniffy Joe is going to raise capital gain taxes on some certain level of people. I get that, but that's a near-term thing. But to sit there and say the government's going to get rid of Roth IRAs and I don't even care what it is. There's nothing on the table to do that. It's basic speculation. They should not tax plan on that. You should tax plan on the reality on the ground, if that makes sense.
And the reality is we started in 1997 with a $1,000 a year Roth contribution. Right. We've gone to $2,500, $3,000. Now we're at $7,000, right? So that contribution amount has only increased.
Yep.
The second reality is that now we have a Roth 401k.
Exactly.
Before we did not. The third reality, and this is in the 2017 Tax Cut Jobs Act that Trump had, that now if you have after-tax money, you can roll over that basis into a Roth IRA, right? So you don't have to pay taxes on that piece, right? So that's, we've had over 20 plus years of legislation that make Roth IRAs, Roth 401ks, a more integrated part of planning. And the last thing I would say is that the government needs income.
Exactly.
They would rather that you pay taxes today to solve the needs of today.
100%, and don't forget, Amar, you used to not even be able to convert to a Roth if your income was so high. I mean, it was the same thing on convert. Now, I think that was the Pension Protection Act, I think, or the Bush tax cut, I can't remember. But you had to have minimal income, married filing jointly, I don't know, $150,000 to even convert. So all the stuff for Roth has enhanced it. And ultimately, I think it goes back to what you said. The government wants the money today. They'll kick down the bill down the road. So
let's go to the next slide, Josh. Access to liquidity.
Oh,
I think this is key because when people have investments go up and down.
Yes.
If your investments are down, you're going to want that liquidity. And you're going to want to, if you need access to your capital. So one of the things that I've experienced with clients is that in 2008, 2009, let's say you had a large expense like college, right? And they needed to withdraw money from their investments when investments were at their all-time lowest, right? And so you want to make sure that you have access to liquidity. I mean, that is so important. You should always have a safe place to access liquidity. I mean, I think that we can say that over and over too many times.
Could not agree more. This is where I think experience as a financial advisor comes to play, because the stuff you learn from real live people, it shows you what to avoid. And we all have experiences where I'll give an example. They got rid of they cut out home equity line of credits. You know what I'm saying? Their home equity line of credit, they said, snake. And you're like, dude, that was my savings account. You hear that? Boys, that was my savings account when times got tough. Is my home equity line. Hey, stop. And then when the USA and other banks limited your access to home equity lines because the market decline, a lot of people are freaking up the the creek without a paddle. It's not good. You have to have some source of access to equity, more than just relying on what you think is safe, because it might not work like that.
Yeah. Yeah, and I think access to liquidity also buys you control, right? So one of the things that we do is that we don't reinvest dividends. We have dividends going to cash, so then we can control how we're investing those funds. And maybe you need income, right? So then you can have those dividends go into cash and use that to cover some of the income or expenses.
But no one ever went to bed at night unable to sleep because they had too much cash. I mean, that's just, I mean, no one ever said, I can't sleep because I got too much cash. And that's just a fact. And secondly, on this regard, Amar, I mean, my goodness, let's not forget there's just simple stock market speculation on my end. We've had 12 years of significant upside with only one bear market. That was the shortest, even though it was a violent bear market, but it had never seen a bear market recover itself so fast, ever. So we've only had one bear market in the S&P 500 for 12 flipping years, and that bear market was just a blink of the eye. I mean, by the time it was done, and you got your end of Q1 statements of last year, it was yesterday's news. We had 19.4% in Q4 of 2018, not an official bear market. May to June of 2015, we had like a 14% decline, not a bear market. And then, like I said, in 2011, not a bear market. So it seems to me, especially if a $15 minimum wage comes in, especially if we're going to get rid of fossil fuels, that we have a significant opportunity to raise liquidity to avoid selling stocks if they do decline. Now, I have no idea if stocks, the facts are the stocks have done better under Democrats than under Republicans in the last, 30 years. But who knows if that's going to continue? I don't know. But all I know is that the one thing we don't want you to do is sell stocks that are down 50%, a la 2007 through March of 2009. We want you to have some source of cash, and the cash should not be in a home equity line of credit, because we saw exactly what happened in 2009. They started pulling them back. So you got to have some source of liquidity to put food on the table, man, for sure.
Yep.
Let's look at these. Let's see. Market. Yeah, market doesn't care who's president. I to some regard, I think that's true, Al. Another regard, I'm not so sure. The market loves cheap money, if that makes sense. And the Democrats, with their spending, are more notorious for cheap money. That's just a fact. Now, with that said, let's not pretend the Republicans are freaking tightwads. They're not. I mean, my goodness, we haven't had a balanced budget until Clinton. Now, it wasn't because of Clinton, it was because of Republican Congress. But Republicans under Reagan, under Nixon, under George W. Bush, and then under Trumpster, not one balanced the budget, not one. The only time they had to balance the budget was under Clinton for like 2-3 years back then in the late 90s. And so let's not pretend like the Republicans are, they're going to cut spending. Yeah, we've yet to see it. No one's even advocating it. These guys are all fake. Hold on a second, Amar. We'll see. Amar says, Vino says, Amar, that's how to do it. Keep a pool of cash that dividends flow into, and then invest the excess. I don't know. I don't like that so much. I get what you're saying, Amar. I just a lot of brokers do that for sure. I like to reinvest the dividends for sure, but to each his own. I personally don't like. I like to just reinvest. That's for sure. But I get how people. I know by the guy who brought me up as a broker. He used to do that. He used to take all the dividends and hold them in cash, and then he could buy something else when the market fell, which is not a bad strategy. But I don't do that. Rosemary says liquidity is the future. That's a revolution on our doorstep. I'm not sure what you mean by that, Rosemary. The liquidity is the future. That's a revolution on our doorstep. Yeah, I'm not sure what that means. Hold on just a second, Mark. We're just going to cut through some taxes are going to cost me some money. Refinance mortgage will pay off the truck loan with COVID blessing. I took IRA to pay off mortgage and be debt free. 3 years to pay tax on the IRA. Yep, that was not a bad deal, Al. Good on you, man. Vinyl says these robo-advisors don't state the risks of tax loss harvesting, selling covered calls. You can lose a big upside if you're unlucky. Jeremy Rhodes says, nice. He's talking about your hair, Mar. Mar's hair is so nice.
I need to get a haircut.
Things
open again. So the last bullet point, if we want to hop to number 5.
Yep.
And I know it says advisor client transparency, but I mean, having a third party kind of hold your hand or to be your sounding board when you make some of these investment decisions, I think is key, right? And however you're going to do it, I think that having that schedule or dialogue would be good.
Amar,
Pink Floyd.
That's probably the most important question. Do you like
Yeah, I mean, what was it? Alice in Wonderland? There was that soundtrack. That's to Pink Floyd, right?
I have no idea. Pulverizer knows my disdain for Pink Floyd and all things Pink Floyd. Oh my goodness! So he's trying to get you and I to fight. Vinyl says, "See you on the dark side of the market." Right on. All right, so I do want to talk about advisor transparency. I would like to talk about this here for just a second.
Sure.
This is one of the things actually. This is going to talk about fees as well as taxes. I'm trying to be nice when I say this. I'm not so sure a lot of advisors actually know what. I'm trying to be nice. I'm trying to be, what's the word I'm looking for? Diplomatic here. I don't think a lot of advisors actually know two freaking craps about how capital gains are distributed on mutual funds and or ETFs. I think a lot of advisors, because they have to make a sale, they're going to sell you on performance. And I don't like that. I think it's bad. No one should like that. And so when they're selling you on performance for the last 3 years, inherently that means you're most likely buying a pretty significant tax trap for sure. And part two, they don't know what the 1099 dividends coming out are. They don't know the capital gain distributions. A lot of them don't even know what buy the dividend means, even if they have a Series 7, because they've simply forgotten. A lot of advisors don't focus on the tax stuff.
I think we can just step back and say a lot of advisors are part of the big firms, and big firms have cookie cutter models that clients are in. And so the advisor role is not really to invest the funds and figure out a tailored strategy for you. That advisor's role is really to gather assets.
100%.
So what's happened is that because everybody's trying to scale in our industry, that there's a separation between an advisor and somebody that's actually doing the investments, right? And those roles in the past were one and the same, but now they're separate, right?
And another thing that actually annoys me too, I don't like advisors who don't have at least the ability to talk about taxes. So a lot of advisors, Amar, and you probably know this too, talk to your tax advisor. And I'm like, well, you are the one recommending me an investment strategy. Inherently, if it's investing strategy, it's going to have tax consequence. Not to be able, and I don't even blame a lot of advisors per se. It's a lot of the big firms. They say we can't talk taxes. It's freaking.
You have to stay in your lane, right?
Yeah.
You don't want that liability that if you tell somebody to sell something and tell them that there's a tax consequence that you may be giving tax advice and there could be liability on hand.
Well, let me address that. I'm going to stop this thing. I want to address that because that is actually a thing. You got to allow us to thanks to these live streams. Great info. Right on, man. Yeah,
and they're planned. So it's going to be every other week. Yeah. And we're going to cover those 13 topics.
I wonder if I can set it up like on StreamYard where it automatically, we'll figure that out. But anyway, so these big firms, they are so worried about being sued because they have so many people to police up. Amar and I both worked at big firms, both at USAA, JP, or where are you at? JP Morgan?
Before this, I was at JP Morgan and then American Express.
Yeah, so I was at Smith Barney. And so what happens is the firms say, we don't want you to say anything, basically, because we can't police up everything that comes out of your mouth in case we get sued for. And as such, the big firm guys, they can't roll up their sleeves and get knee deep into the detail because their firms don't let them. I'm just telling you right now. I'm telling you right now. I remember I posted on LinkedIn back in 2016. I said, man, the Roth IRA is a wonderful strategy. Everybody should consider it. I got dinged by my compliance guy. I said, this is insane, man. It's just the whole thing was nuts. So a guy like Amar, for instance, works for a big firm. No, it's just Amar. It's Amar.
It's me.
And so Amar is as 100% liable to his clients, where the big firm, the guy that you're dealing with at the big firm, isn't liable. He's just not. It's not. It's not. I mean, his firm is, but his firm recognizes that, so the firm shuts down any kind of dialogue that comes to taxes. And then, if you think about it, the firm can shut down dialogue that comes to taxes, i.e., should you do this or do that? Well, I can't say that. Talk to your tax advisor. Do you think the firm literally is going to allow that guy to go deep into a specific investment strategy? No, because the firm is scared crapless. And so that's the thing about a registered investment advisor. And look, this would be a sales pitch for a guy like Amar, but Amar specifically, is that you're getting him because he is a fiduciary. Now, I disregard a lot of the people say, I'm a fiduciary. I don't give two craps about that. But I do give a crap about an RIA who runs his own firm, because ultimately he's responsible to you as a client. And he's not going to sit there and say, I mean, if he does sit there and say, go talk to a tax advisor, if it's just basic tax stuff, then get a new financial advisor, because that's weak sauce right there. And it really ticks me off when people are like, all right, I'm like, dude, what's my 1099 going to be? I don't know. Talk to your tax advisor. What's the point? What is the point of you existing then? It doesn't make sense. And this is where an RIA can really come in big for someone who says, look, man, I need a plan of action to make sure that I'm firing away on all cylinders. And if you're working with a big firm like that, I'm sorry, they just don't have the capacity because out of fear. And maybe that's rightful fear, because my man Vinyl just talked about Chase, where got sued big.
I mean, so like most RIAs don't manufacture their own products, right? I think that's the biggest separation, right? Is that there's a separation between the actual end product and the person giving you advice, right? And I think that allows most RIAs to be independent and objective.
Mark, can you see the chat, or is it just me? Rosemary?
Yeah, I can see it, but I have to look off to the side. So yeah, these are pictures I've taken from this is New Zealand to Kenya.
Right, you've been all those places?
Yeah, I'm a world traveler, Josh.
And you're still
pre-COVID.
Yeah, right. Have you ever been to the great state of Maine?
I've driven through it on that I-95 to Boston.
No, so you just passed by, huh? Probably threw out your beer cans on the side of the road too.
Actually, I actually got in a car accident in Maine.
Really?
It was raining and like somebody rear-ended me on the freeway.
Freaking Mainers, can't stand them. Is there any? Thank goodness we don't have any Mainers on this line right here. We do.
Josh, can I just interject real quick? And can we put the disclosures up so that way we can get that out of the way?
Yep.
And
I don't have them. You got them?
I have them. I can put them up.
While you're doing that, Vinyl said he worked at Chase, and they had 10,000 lawyers. 10,000 lawyers. Let me put that up, Amar. Can you? Oh, wait, maybe I gotta.
Yeah, you can see it there.
Okay. Wait. We can. Can the rest of the people see it? I don't think so. I
think so. It says it's live.
Let me. I gotta add to. Yeah. Okay. 1 second. Actually, where is it? Oh,
so basically, the disclosures say this is basically educational content, right? This is not specific advice or specific securities. And we haven't taken into account all the various factors in your personal situation. It's something to keep the lawyers happy, I guess.
All right, they see it. Cool. This is live simultaneous on 3 channels, Rosemary. The Josh Scanlon YouTube channel, the Heritage Wealth Planning, and Amar's Client First Cap. So let's see. I saw some questions in here.
Let's answer some questions so that way we can.
Yeah, man. I saw one from Marie right here. All right. So can you see that going forward? Should I be in growth mutual funds or value? What's your thoughts there?
I mean, it's, without getting in trouble. So you have to remember, I'm registered with the SEC, so we're not able to give blanket advice type statements. But depending on your risk management process, you're going to tilt one way or another between growth and value. It's something that that I think I'm going to avoid answering directly. Yeah, I mean, we believe, value got hit hard in 2020, and there was a lot of rotation out of it, but maybe some of that rotation comes back this year.
Well, let's.
I don't know.
So, guys, this Amar won't be, and I can't answer that, Marie, specifically either, because we can't say should you do anything without knowing your whole financial situation. But with that said, let me just tell you, at the end of the day, growth over the last 5 years has smoked value. That's just a fact.
Yeah.
Looks like the last 3 months or so, value has come back off the mat. It looks like it's picking itself up. The two ways around this is to just buy the index, VTI or the S&P, and then you have both. That's one way to say, all right, I don't know which is going to do better or worse. As I've said a million times on Sunday, my biggest holding is VTV. That's a Vanguard Value Index Fund, a large cap value index fund, because I came up under the idea of value outperforming growth. And if you look at my bookshelf here, you see Stocks for the Long Run. I got not one, not two, but 3 editions of that by Jeremy Siegel, where he looks back historically and says value has outperformed. We got French and Fama, the guys, one of those won the Nobel Prize in economics, and they're the dimensional fund advisor, the brains behind DFA. And they said their 3-factor model was value is outperformed historically than growth. And the value was based on low price to book ratio, PB ratio, low price to earnings ratio, and high dividend yield. The problem is no one knows that going forward. No one knows. Now, if you come up like me, you say, because that has been inundated and ingrained in your brain, you can't help but just naturally gravitate towards value, especially when it's underperformed for these past 5 years. Especially in the late 90s, the same thing happened. We used to have the same rotation. Large cap growth, up. Large cap value, did okay, but no one wanted to touch it with a 10-foot pole. Same thing happened these past 5 years. So just from pure speculative nature, you say, well, if I'm a contrarian, I'm going to go to the thing that was on the ground, which would be value. But there is something to be said about cutting your losers and riding your winners. And growth has been a winner for 5 years now. But at the end of the day, the best thing to do as an advisor would tell anyone is to just split the difference and buy the market and just, you have a combination of both for sure. The one thing I would recommend against, if anyone had just solely large cap growth, I don't think that's a good investment strategy at all, because the market has done so well. You'd be freaking stupid not to take some gains off the table and reposition some of that to value. And I just, give you an example. We talked about this a couple of times already, not today, but it was S&P, like 30% of it now is the big 5, Amar. Is that what it is?
Yeah. There's 5 companies that control 30% of the, and it's all the FANG, it's all the technology side, right? So
it's like literally it's a repeat of 2000. It's not, man. And then I'm just looking like a Tesla. Tesla was literally up over the last, this is insane. It was at 186. It was at the start of the year. It was at like 140 or something like that. Now it's at almost 900. So Tesla's up like 700% in a year's time. That's, and if you go to 2 years, it was back like a 54 2 years ago. Yeah, these are gains that are just unheard of. You don't get those kind of 4, 5, 10 baggers often. And now they're adding Tesla to the S&P 500. What does that do for the S&P 500 in terms of this price to earnings ratio and all that? It makes it higher because you have Tesla, you got Facebook. I think Facebook's PE is not bad, but Amazon still has a high PE. And all these companies are the dominant players of the S&P 500. They're all growth stocks, and their PE ratios are through the roof. And that's the argument for value. But the problem is, I can't remember if it's Buffett or Keynes, I think. John Maynard Keynes says, the market can be irrational longer than you can be solvent. So as much as I can pound the table like Khrushchev at the UN, the facts are the market doesn't give 2 craps what I said. The market does what the market is going to do. And at some point, value will come back. We just don't know when, where, or how. So just split the difference, buy the index and be done with it. That's actually the safest strategy there is. Anything to add on that?
No, but there's a bunch of questions here.
Okay.
So there's one on Reits, and Reits, they have to transfer 90% of their.
Who asked? I can put it up here. All right. All right. Here's Jennifer. What are the cons of? Is that what you're talking about?
Yeah. So REITs. One of the risks they have is that if we go into rate, how REITs pay their dividend. Typically REITs have a high dividend, and that's what attracts investors to them. But sometimes those dividends are not paid from free cash flow, right? So what they're paid is that they take on a loan, and they use some of that loan to pay the dividend just moving forward, right? And when you have REITs that have in a raising interest rate environment, their margin gets squeezed. So some of that is something to be not concerned with, but kind of look at as one risk factor. Another risk factor is, a lot of these companies are going remote. So what's going to happen to Class A, a Class C real estate? And that could be a concern. But there are REITs that do manufacturing. There are REITs that do distribution. There are REITs that do only hospitality. I bet those have gotten hit really hard because of COVID, and you could probably buy them at a discount. So there's different types of REITs. So you should know what type of REITs you're investing in. What are the underlying holdings? And somebody mentioned that they own their REITs in a Roth. REITs are supposed to create stable income, right? That's why I think it's like, correct me if you think differently here, Josh, but I think it's like almost 60% of REITs invest in mezzanine debt or invest in like loans for these big buildings, right? They don't actually own, their entire portfolio is not owning the buildings. There's some debt instruments there.
Oh. So what's mezzanine debt? I don't know what that means. What is that? Mezzanine debt.
So let's say if you're buying a building, and the building, I'm just going to use round numbers, is $100 million, then the bank will loan you $60 million, but you only have $20 million to put into it. So you need $20 million more in lending, right, to get to purchase a building. So that's considered a mezzanine debt. So if you think of the debt structure, you have the bank for the first 60. Well, let me explain it backwards, the other way around. The first dollars at risk are the equity that you put in, right? When you're buying the building, then it's a mezzanine finance, the next 20 million, and then it's the bank, right, for the 60.
Mm-hmm.
So what they're able to do, since they're taking more risk, is get a higher rate of return, higher interest rate, right? And so I just be careful with those, especially with non-publicly traded REITs. I think there's a lot of people get into trouble, again, with liquidity, accessing their capital when they need it. Most of those, I think, only get reappraised once a quarter, right? So you say, oh, my investments are doing well, and then you see this big drop. And then
non-publicly traded, you got to be an accredited investor for that? Or how do you, if it's not
buy index funds that have REITs, you can buy specific, you don't...
No, but for the non-publicly traded ones, there are index funds that invest in non-publicly traded REITs.
No.
Oh,
they're publicly traded REITs.
No. How do you invest in non-publicly traded REITs? You know what I'm saying?
So
you gotta be an accredited investor or something like that, or
no? You just go to an advisor that has an ability to sell REITs, and then you can
purchase. Okay, gotcha. Yeah. And they're not publicly traded, so you're only relying on the good faith of the issuer, essentially, to pay you back. Is that what it is? Yeah.
So the REIT is an actual company, right? So there's an advisor that would sell that REIT, the non-publicly traded REIT. They make a commission. And now your dollars are.
I got you. Okay. All right. I got you. Okay. No, there's some. I see what you're saying. There's a couple. I see what you're saying. I've never invested in that. There was one that was actually kind of interesting to me. I was looking at like farmland. This guy was investing in apple orchards up in not this guy. It was actually seemed pretty interesting to me. And I said, I don't have enough money to speculate at this stage. But that would be an example. You have to be an accredited investor. And you're basically investing specifically in these guys, and these guys will pay you back or they'll go bankrupt essentially. But you can't trade it on the market. That's what a
non-traded. Yeah.
Oh, right on. Kim says, "What's growth and value?" Let me just talk about that real quick. So we talked about value a second ago, Kim, but just to to clear it up, a value stock is actually riskier because the reason it's value because for some reason it's been beaten down. And like, I don't even know what GE is doing anymore, but GE's would be an example of a value stock that has had, it's just been beaten down. It's been beaten down big time. So it's a value relative to its price, relative to its earnings, relative to the dividends it has, relative to its, what's called book value, whatnot. It's if GE were to say it trades at 10 as a price to earning ratio, has a 5% dividend yield, and has a 2 price to book. Whereas we'll just use Amazon. It has a 96 price to earnings ratio. So Amazon trades significantly more expensive than the earnings it makes. And remember, the thing that drives the markets, the one thing is always earnings. Now there is speculation. I get that. That's where you get capital appreciation or capital depreciation. But everything else is driven on earnings and dividend yields. So the history of the academia would be that value outperforms, and inherently that would make sense because value is more risky. The facts are GE is more likely to go bankrupt than a growth stock that's tearing it up. That would be the thought behind that. And the riskier your investments, the more upside there is. And as such, value has outperformed over time. But we don't know if that's going to continue. In fact, if you look at everyone says small cap value dominated the market, going back to 1926. That was I don't know if it's still the case, but basically as of 2008, that was still the idea. And I'm just buying small cap value. I'm buying small cap value. But if you took out a 6-year time frame from 1977 to 1983, small cap value did not outperform the market. It was just another market performance, which was fine. But the things are that everyone wants to slice and dice, and okay, small cap value did outperform, but you had to be in there for it to have outperformed. And if you weren't investing in 1977 through 1983, it did not. So I wouldn't get too caught up in it. The only reason I get caught up in it is because I've been doing this for so long, and it's my nature. It's kind of like, my nature to hate the Yankees. I can't stand the Yankees. My nature to hate Pink Floyd. I can't. That's just as who I am. As such, value stocks for me, because it's where I was raised on, will always have a special place in my heart. Some guys are talking about some serious financial software, not software, but LDAP, hook them up to apps and get the users in the group to ensuring they have the right approvals. Let's see. We're talking about the cons of Reits. I'm new to the IT world, so I'm looking to get the most experience I am. Tesla, where's Harry? Oh, here's a good one. REITs are taxed as standard income, which is the inherent problem with them. Oh, that's good. So So REITs are taxed as ordinary income. Okay, I did not know that. That's why you don't want REITs in a taxable account for sure. You think, Amar, the REITs, they're basically betting on leverage as opposed to capital appreciation? It sounds like if you're, what I'm saying, like the mezzanine debt they're buying and stuff is like a leverage potential.
Yeah. So I mean, each REIT has their own strategy, so each REIT will be different. But some of the strategy could be to own the mezzanine debt to get the yield, right? The second thing could be to say we believe this property will go down in value, and then the owners of the property will no longer want the property, and then they have the right to purchase the property, right? In that last example, 20% discount relative to today's prices, right? So
because of mezzanine.
Yeah.
There are at least 2 car companies I know that are going to electric car manufacturing. Okay. That are going to compete. I was reading an article the other day that said, I forgot who the companies were that were going to compete heavy against Tesla. I was reading about the Japanese CEO of Toyota, basically saying there's not enough electricity, essentially, to power all these EVs that the government wants to come to market. I thought that was pretty interesting.
Yeah, Toyota is doing a lot of hydrogen, right? That's their push is hydrogen cars.
I don't know. Maybe. It seems like I got a book on there about hydrogen back in that. It was a big shindig back in the 60s, so I'm not sure why that seems to come back now. In the 60s, hydrogen was all the cat's meow, and then that went away. And now it's back. Who knows? That's the thing. No one knows, so you just buy the market because there's always going to be something that you don't know that's going to come around. Verizon, an example of a good value stock. GE is an example of a bad one. How can anyone rational hate Pink Floyd? Volkswagen, yeah, maybe that's what it was. They're getting knee deep into EVs.
After all their diesel emissions issues, they have to go like a pendulum the other way.
The sad thing is just not enough diesel mechanics. I'd own a diesel if I knew how to work on it, which I don't, because freaking diesels are awesome. I have I don't know what those are. All right, so what Jennifer says, thanks, Amar.
Thanks.
Vanguard REIT, any thoughts? Vanguard REIT ETF, Amar?
No thoughts.
Amar says, load up on it right now. Get in while you can. Jeremy says, RMR. I don't even know what that is. You know what RMR is? Let's take a gander. I don't know what it is either. I don't know. RMR Group. So it sounds like a REIT. Yeah, it's some kind of mortgage trust. I don't know, man.
Do you want to share the page that we created for our relationship?
Yeah. Yeah. Good thing. All right. So just
making sure that we have clarity around like our relationship is.
So some folks, they want more of a, what's the word I'm looking for, of a high touch approach. And they want financial planning done by a real life financial planner. Because my approach isn't as high touch as what some people need. Some people need 4 or 5 meetings a year. And so what I've done is I basically beat up Amar to say, give my clients a discount on your first year. You can see that. So basically we'll leave this up here. Actually, I'll put it in the show notes. I'll put it in the comments here. If you want Amar to run a financial plan for you, and he will go in the high touch category that it does, he will charge you $5,000, which is a significant discount on what he normally charges for people. And that's $5,000 for the full financial plan with all that comes into it. It's a deep dive. Trust me. We've talked about this in pure detail. I said, look, man, if you're going to do this, you better be on the clients like white on rice, because you could be, taking away my own clients, and he's not, because Amar does, he's on you 5 or 6 times a year, and that doesn't even, you don't have to have Amar manage your money. You don't have to do it.
Yeah, it's strictly for advice.
Yeah. And now you could decide later on that you want him to manage your money. He's willing to do that, but you don't. This has nothing to do with that. So if you want a financial plan and you want more than what I do, which is a lot more high touch stuff, where we're going to go boing, a boing, a boing, a boing, 4, 5, 6 times over the course of the year. This is the way to do it. And I put that link in the show notes there in the comments, and you just reach out to Amar. There's no obligation. You can talk to him and say, what do you think? And I think Amar he told me about a guy that just wasn't a fit. And Amar said, we're not going to fit. I forgot what it was, but it's like, look, man, he's not going to sell you anything. He's just going to talk about what your circumstance is. I am trying to help Amar build his YouTube channel ultimately. You see what I'm saying? Because I think more good guys that do this stuff on YouTube, as long as we're not banned, is good for everybody. Now, on the other hand, it's also good for Amar. It's also good for me, because if YouTube can get money from having more financial guys on there doing good stuff, that means they're going to promote more financial planning guys, which is a win for YouTube, a win for me, and hopefully a win for you guys, so you don't just hear a bunch of insurance salesmen. So I was able to negotiate this down for Amar for $5,000 for the first year. You're not having him manage money. Unless you want, then you can discuss that with him. Part 2 of that is, if after a year you don't like Amar, you say, I'm out of here. It's completely on you. What do you want to say about that, Amar?
Yeah. So our website is clientfirstcap.com.
Oh.
And, I saw that question. So we can give advice on business structures in terms of for asset protection, retirement plans, defined benefit plans, executive benefits, but we're not attorneys, so we can't give you legal advice about, the structures itself, and we can't, create a LLC for you either, right? So, but we can help guide you in that, and we can go from there. So
Amar interviewed a lawyer out there in California too. You had her on your YouTube channel. Is that a partner you work closely with, Amar?
Yeah. So we do a lot of stuff around estate planning, and if you go back to the tax piece, on the very last page, there's this triangle diagram. I don't know if you have that. Yeah.
Where do you want me to go?
So go back onto the tax piece that we had up.
Oh, okay, hold on a sec.
And then if you go to the very last page, there's like this triangle diagram that we made up. So our core of what we do is to make sure that we're in alignment from a wealth planning standpoint with your no, the other page.
I see. Okay, gotcha. Hold on a sec. Let me
it's in alignment with what's important to you, your family dynamics, and then working with legacy planning. So connecting the three dots together, is really the key of what we do in the planning perspective. Do you want me to get it up there, Josh?
I got it. Hold on just a second. I keep screwing it up. Right here. I think this should be it. Yeah.
So go to the last, keep going down.
Oh, okay, right there. Yep.
Yeah, right. This triangle right here. Right. So it's integrating what's important to you with your planning, and that's looking at investments, taxes, risk planning, and estate planning. So the attorneys that we work with are really along the lines of, how do we navigate, your wills, your trusts, if you have any irrevocable trusts, and how do we navigate that with what's going on in your personal life, family dynamics, and planning for multiple generations.
Right on, man. Yeah. So if you're interested in Amar, hey, sign up on that website I just put in there, and I'll put in the comment section after we get off here. And don't forget though, if you're interested in the other thing, you can the PDF. Sign up for that too. I mean, it doesn't cost anything. It's it's not going to solicit you. All right. So lastly, let's see. Okay.
Yeah. So Jeremy asked if our LLCs, so you can have a single member managed LLC, and you can file as an LLC or an S corp, depending on how you're doing your tax strategies. And I guess there's a book called Single Member LLC. Yes, I guess you can find that on Amazon.
All right, good. All right, so so remember, every Wednesday at 12:30 Eastern, every other Wednesday for the next 12 weeks. So this is the Masterclass, and when you guys are done here, you're going to be masters on financial planning, wealth management. So the next time I think is, do we have I don't have the 13 things up there. Can you bring it back up, Amar? I think next time is.
Let's see, how do I do this? So I'm going to put it here, go StreamYard, share.
Yeah, 13. There you go. I think I got to add this stream. Yeah, make that big. All right, so next time we're going to make it a little bit bigger, Amar.
Qualified retirement plan.
Oh, yeah. Oh, man, it's going to be fun. Still can't believe we got freaking sniffy. Oh, my goodness. The human emotion being depressed. I'm depressed today. I'm not going to lie to you. Jeez. Oh, you were able to cancel that out? Sweet. So remember, folks, if you are like me and you're disgusted with Sniffy Joe, we can be sentimental together because we're all in this together, man. All right, I'll keep the politics off there because Amar doesn't want to say anything to jeopardize any financial relationships.
Well, the truth is the market doesn't care if it's a blue president or red president. They care about green, right? Like money to be made. So fiscal and monetary spending probably means more than any of this other stuff.
Well, the fiscal spending is from elections, though. You know what I'm saying? But at the end of the day, this is, well, just real quick. At the end of the day, the saving grace is what I've said a million times Sunday. It's a 50-50 split in the Senate. They got a 7-seat majority in the House. Biden, while he's nuts, he's not a commie, for the heaven's sake. He's just, look, man, it's a corporatist from day one. He's got some crazy loons in his cabinet. I get that. But America survived worse. You know, hell, we survived Nixon and Carter back to back. So, well, I guess it's Nixon, Ford, and Carter back to back. We're going to survive this. Just sucks when your guys lose, man. You know, seeing Tom Brady lose against the Giants when they were 18-0. No one remembers the 2007 Pats, Amar, 18-0. Should have won the Super Bowl, except for David Tyree.
And Rosemary mentioned if you could please go and subscribe to my channel, right? Client First Capital Learning.
Yep.
And hit the like button, like Jeremy mentioned here as well.
Jeremy, are you a Pats fan? Given that you're from Maine, Jeremy's from Maine, Amar. He probably hit you, you know, because of freaking Maine is only one part of the whole state. All right, my friends, I'm going to get out of here. Appreciate Amar. Thanks for being on here. Don't forget, I'll put links in the show notes when we're done. There will be all this stuff is available, George. You can watch the what's it called? Not the live stream, but I don't know, the replay. It's always available, man. And watch it and make sure you watch the ads so we can get that sweet, sweet money from George Soros and the boys. All right, guys. Thanks again for being here. Amar, I'll text you here in just a second. See ya.
Bye, guys. Thank you.